Okay, so listen, you know how you walk past two cafes right next to each other and they're both selling lattes, but the prices are totally different?
Yeah.
That's kind of what the banking world is like when it comes to deposit rates. We're going deep on that today.
All right, I'm excited.
We're digging into this research paper, The Deposit Business at Large versus Small Banks. And trust me, it is dense, but we're going to pull out the good stuff, I promise.
Sounds good.
First up, gotta tackle this myth. Do big banks really offer the same interest rates everywhere? Like, if I walk into any branch, am I going to get the same rate on a CD?
Yeah, that's what most people think, right?
Right. And you'd be surprised the research actually starts with that assumption that big banks love their uniform rates.
No.
So then they dug into the data and get this. Almost 99%, 98.8 to be exact, of the variation in those 12-month CD rates comes down to what they call the bank time fixed effect.
Bank time fixed effect. Catchy.
Right. Okay, so in plain English, that basically means those rates are mainly different just because it's a different bank at a different point in time. Big banks really do stick to those uniform rates for some of their products.
Huh. So it really is like that chain restaurant menu, same burger, same price,
Yeah.
whether you're in California or Connecticut.
Exactly. But why do they do that? Think about it from their perspective. For a massive bank to analyze every single local market and set like slightly different rates would be a logistical nightmare.
Yeah, and can you imagine the customer complaints? Someone in New York finds out they're getting a worse rate than someone in Texas?
Total PR disaster. It's so much easier to just keep it simple and offer those other perks to attract customers. So we kind of busted that myth. Big banks like those uniform rates, even if they are a little lower. But now the big question, does that mean we should all be running to small banks with our money if we want to see better returns?
Oh, hold on a sec. It's not quite as simple as big banks, bad rates, small banks, good rates.
Oh, really?
Yeah, this is where the research gets interesting. They found that small banks will actually lower their rates sometimes when they're competing with the big bank in the same local market.
Oh, seriously? That seems backwards. Why would they do that?
It's all about market dynamics. Take a look at figure 3 in the paper.
Okay.
See how those lines are sloping downwards?
Yeah.
That's showing what happens.
Okay, I'm seeing it, but explain it like I'm 5.
Uh-huh. All right. Small banks, especially those in smaller towns, know their customers are really paying attention to those rate changes. Every penny counts, right?
Totally.
But when a big bank comes to town, it's not just about rates anymore. They've got all those extra perks. ATMs everywhere, online banking, maybe even some investment options.
True. Those perks are pretty tempting.
Right, and that's the thing. It boils down to what we call compensating differentials. Large banks can offer lower deposit rates because they're attracting customers with all these extra services that cost money to provide. It's a trade-off.
So it's like choosing between the basic gym membership and the one with all the fancy extras.
Exactly. And what's interesting is the research found, this often comes down to demographics too, who lives where, how much they make, what their priorities are.
So it's not just about banking differently. It's about totally different customers with totally different strategies, right?
Exactly. And the research actually looked at this geographically. They mapped out where all the bank branches are and looked for patterns.
Okay, let me guess. Big banks are all clustered in the big cities, and small banks are sprinkled out in the smaller towns.
You got it. Figures 5 and 6 in the paper show this really clearly. Big banks are all about those high population, high income areas, and small banks are holding it down in those more rural, price-sensitive spots.
Fascinating. But so what? Why does this segmentation matter?
Well, it has big implications for your money, and it all comes down to something called rate semi-elasticity.
Rate semi-elasticity. Okay, you're going to have to break that one down for me.
Basically, it means how much your deposit balance is likely to change based on the interest rate a bank is offering. Are you a loyal customer who sticks with their bank no matter what? Or do you jump ship for a better rate somewhere else?
Haha. Okay, so I'm guessing most people fall somewhere in between those two extremes.
You got it. And the research found something really interesting. Customers at small banks tend to be way more sensitive to those rate changes than big bank customers.
Makes sense, right? If those deposits are a bigger chunk of your savings, you're going to be watching those rates closely.
Exactly. And that gives small banks a powerful tool. They know they need to stay competitive to attract and keep those customers.
So what I'm hearing is this isn't just some abstract economics lesson. This is about understanding how those deposit rates work and how they can affect your own bottom line.
It's all about making those deposits work harder for you, whether you're at a big bank or a small bank.
Awesome stuff. Big thanks to our expert for breaking it all down for us, and to you, the listeners, for joining us on this deep dive into deposit rates. Until next time, happy banking, everyone.